Hi everyone, welcome to another episode of The Naive Investor. Today we are looking at what is happening with the US market. For those who have been watching the US market for the past few days, you may be wondering what the fudge is going on. Are we looking at a short-term correction, or are the bears correct and we are heading towards a dramatic crash? Let's find out. The topic at the center of all of this is the news about the rising Treasury bond yield. The 10-year US Treasury bond rose to 1.37% on Monday. This is the highest been all year. But what is a Treasury bond? Well, the US Treasury bond, or T-bonds, are government debt securities issued by the US government. It's okay, I hear you. Still a little bit jargony. Basically, it's an IOU from the US federal government. When a government or corporation needs money to fund projects, they can either go to the bank to ask for money or approach the public. Companies go to retail banks while governments go to central banks. In the US, the central bank is called the Federal Reserve Bank, or you may have heard of the term, the Feds. Yep, that's them. For governments, the way they borrow money from the public is through issuing Treasury bonds. Treasury just means bonds are issued by the government. If bonds are issued by companies, they are called corporate bonds. Now with bonds, there are four important things. Firstly, the face value, which is how much the bond is worth in dollar value. And since the government is borrowing your money, they need to pay you interest for your trouble and the opportunity cost. This is known as the coupon rate and is our second important thing. Treasury bonds pay interest every 6 months to the bondholders up until their maturity date, which leads to our third important thing about the bond, maturity date. The maturity date prevents you, the lender, from taking your money out sooner than the intended duration. After a bond has matured, you receive back the face value amount on all of the bonds you hold. Normally, the longer the maturity date, the higher the interest rate because your money is locked up for longer. This also prevents you from using that money for other investments such as stocks. Another important thing with the US Treasury bonds is that they are guaranteed by the US government. If you are looking for a risk-free investment, the US Treasury bonds are widely accepted as such. We have already mentioned the opportunity cost of bonds, but the other risk is inflation. As time flies by and the economy grows, inflation increases, and this decreases your purchasing power. For example, let's say you put $1 million into bonds with a 10-year maturity, and inflation is kept constant at 2% for the next 10 years. By the time the bond matures, inflation would have eaten away at your money. If you discount this to the present value, you would have about $820,000 instead of the original $1 million. The last important thing is bond yield. Bond yield is the percentage you get back in interest on the purchase price of the bond. Even though a treasury bond may have a face value of, let's say, $1,000, when you trade it on the secondary bond market, it may actually cost more or less. Bonds prices follow the same demand and supply principles in economics. During bad economic times, bond prices goes up as investors look for safer investments. In contrast, during good economic times, bond prices goes down as investors move their money to riskier assets for higher returns. Since coupon rate stays constant, the bond yield will move inversely with the bond price. So how does this all relate to what is happening with the market? Well, at the moment, there are fears of rising inflation. Inflation is a double-edged sword. You want inflation because it's a sign the economy is growing. But too much inflation is not good either because it eats away at your purchasing power. With economic recovery in the US is expected to be underway as COVID vaccines are being rolled out, investors are bullish. As such, they take their money out of bonds and put it into riskier assets. In other words, the demand for bonds decreases, driving down their prices. Like we have explained before, as bond prices go down, bond yield goes up. Right, if investors are bullish about stocks, then why the drop? Here's the thing. Investing and trading is all about timing. And right now, there is a collective sentiment that the market is overheating. And a bullish sentiment might make it even hotter. As economic activity starts again, inflation might rise too quickly. And the Feds are looking very closely to make sure inflation does not rise too high. One way to put the brakes on inflation is to increase the federal cash rates. The federal cash rate is the interest rate that commercial banks pay to the central bank. And it is also used in the discounted cash flow calculation for companies' future earnings. Like we have said probably 3 times now, inflation eats into the purchasing power of the dollar. Basically, companies' future earnings are lower if inflation is high. Another thing that pops into the equation is President Biden's massive stimulus plan, which economists are saying way too big. In an effort to save the labor market from further collapse, the Biden administration is injecting $1.9 trillion into the American economy. With this much money floating around, economists are saying most of it will float into stocks, causing further overheating. Also, this will cause unprecedented and unsustainable spending and increase inflation. The Fed would then need to step in by raising interest rates, which can cause a sudden collapse in the market. Fed Chair Jerome Powell gave his semi-annual address to Congress on Tuesday. His words are cautious but supportive of the economy. He acknowledges the recovery has been a mixed bag for the economy. Sectors that involve close physical interactions are still yet to recover. Meanwhile, the housing market and manufacturing are well on their way. So why has the US market dropped over the last few days? In short, investors are fearful of a rise in federal cash rate, which can affect companies' earnings. However, Jay Powell shows a mindfulness of the difficult environment we are in and resolve to be patient with the market. The S&P 500 and the Nasdaq responded positively to this and lifted from its intraday low. The most important question is though, is this a short-term correction or are we facing an imminent crash? Personally, I think this is just a short-term correction, and corrections are a good thing for an overheated market. As the labor market picks up again and productivity increases, we will see a recovery in the economy. This will minimize the disparity between the company's valuation and their underlying true value. And that is pretty much it for today's episode of The Naive Investor. If you like what you see, please share, like, and subscribe to show your support for the channel, as it does take a fair bit of time to prepare for a video. Also, please check out our other videos and leave your comments about this one in the comment section below. Until next time, stay safe and keep looking for opportunities.